October 24th, 1929. Wall Street opened at 9:30 a.m. like any other Thursday morning. By 11 a.m., panic had set in. By noon, grown men were weeping on the trading floor. By closing bell, 11 traders had attempted suicide. This was not Black Tuesday yet. This was just the warning shot. 5 days later, on October 29th, the entire financial system would collapse in a single trading session. 16 million shares changed hands. $30 billion in market value evaporated. In today's money, that's roughly $400 billion gone in 6 hours. But the real story isn't about numbers on a ticker tape. It's about how an entire nation convinced itself that prosperity was permanent, that stocks only went up, and that the party would never end. It did end, and when it did, it took everything with it. Let's go back to 1924. World War I had ended. America was booming. The Roaring Twenties had arrived with jazz music, flapper dresses, and a revolutionary idea. Anyone could get rich. For the first time in history, ordinary people were buying stocks. Not just millionaires, teachers, factory workers, barbers, your neighbor. The stock market became democratized, and Wall Street loved it. Brokerage firms opened offices in every city. Newspapers printed stock prices daily. Radio shows discussed market tips like sports scores. Owning stocks wasn't just investing. It was patriotic. It was modern. It was the American dream on paper. Between 1924 and 1929, the Dow Jones Industrial Average climbed from 100 to 381. That's a 280% gain in 5 years. Some individual stocks did even better. RCA, the tech stock of its era, surged from $11 to $400 per share. A single share bought in 1924 made you rich by 1929. General Electric went from $130 to $400. Radio Corporation skyrocketed. Montgomery Ward doubled, then doubled again. Every month brought new records. Every dip was called a buying opportunity. Financial experts declared that America had entered a new era where old rules no longer applied. Irving Fisher, one of the most respected economists of the time, announced just weeks before the crash that stock prices had reached a permanently high plateau. He would lose his entire fortune within months. He was catastrophically wrong. The problem wasn't just optimism, it was leverage. Margin buying had become the norm. You could buy $100 worth of stock by putting down just $10. The brokerage firm lent you the other 90. If the stock went up 10%, you doubled your money. If it went down 10%, you were wiped out and owed the broker. By 1929, margin debt had reached $8.5 billion. That was nearly 10% of the entire GDP of the United States at the time. Imagine an economy where 1/10 of all wealth is borrowed money betting on stocks. That's not a market. That's a time bomb. And ordinary people had no idea they were holding the fuse. Take Michael Meehan, a doorman at the New York Stock Exchange, who became a millionaire trading stocks. Or the thousands of secretaries and shop clerks who pooled their savings into investment clubs, convinced they were riding the wave of the future. Barbers gave stock tips between haircuts. Shoeshine boys debated which railroad stocks to buy. It wasn't greed. It was faith. Faith that the system was sound. Faith that Wall Street knew what it was doing. Faith that had been carefully cultivated by brokers who made fortunes on commissions, not on whether their clients succeeded. The fuse had been burning for months. In March 1929, the market stumbled. Briefly. Then it recovered and hit new highs. In June, there was another wobble. Again, it bounced back. By September, cracks were showing everywhere. Steel production was down. Car sales were slowing. Construction was declining. Unemployment was creeping up. But stock prices still climbing. The disconnect between reality and the market grew wider every day. On September 3rd, the Dow hit its peak. 381.17. It would not reach that level again until 1954, 25 years later. Then came October. On October 18th, stocks began to slide, not a crash, just a decline. Investors told themselves it was temporary. Professional traders called it healthy profit-taking. By October 23rd, the selling intensified. Margin calls went out. When you buy on margin and the stock falls, the broker demands more cash immediately. If you can't pay, they sell your shares at whatever price they can get. Forced selling creates more selling. It's a death spiral, and once it begins, there's no stopping it. Thursday, October 24th, became known as Black Thursday. The market opened and immediately plunged. Within the first hour, 3 million shares had traded, and every single one was a sell order. Panic gripped the floor. Traders couldn't keep up. The ticker tape, which displayed stock prices, fell 2.5 hours behind. No one knew what anything was worth anymore. Prices became meaningless. RCA, which had been at $400 weeks earlier, fell to $200, then $150. Then no one knew because the tape was so far behind. Rumors spread that the market had collapsed entirely, that banks were failing, that brokers were jumping from windows. Outside the New York Stock Exchange, a crowd of thousands gathered, watching in stunned silence. Police barricades went up. Mounted officers pushed people back. Construction workers on a nearby building stopped to watch, and someone in the crowd shouted that they were preparing to jump. The panic rippled outward. At noon, a group of bankers met in secret at the offices of J.P. Morgan. Thomas Lamont, J.P. Morgan's son. Richard Whitney from the Stock Exchange. Representatives from the biggest banks in America. They pooled $240 million to stabilize the market. Whitney walked onto the trading floor at 1:30 p.m. and placed large buy orders for blue-chip stocks at above-market prices. U.S. Steel, General Electric, AT&T. The gesture worked, temporarily. Prices steadied. By closing bell, the market had recovered half its losses. Headlines the next day proclaimed that the worst was over. The bankers had saved the day. It wasn't over. It had barely begun. Friday and Saturday passed quietly. Markets were closed Sunday. And then Monday, October 28th, brought devastation. The Dow dropped 13% in a single session. 9 million shares traded hands, shattering all records. Margin calls flooded in by the thousands. Investors who thought they were wealthy on paper discovered they owed more than they owned. Suicides were reported, not just on Wall Street, across the country, in hotel rooms, in quiet suburban homes. The crash was no longer a New York problem. It was everywhere. And then came Tuesday, October 29th, 1929, Black Tuesday, the day Wall Street died. The market opened and instantly collapsed. There were no buyers, only sellers. 16 million shares changed hands, a record that would stand for nearly 40 years. But volume didn't matter. There was no price discovery. Stocks sold for whatever anyone would pay, and most paid nothing. The ticker tape fell 5 hours behind. Brokers had no idea what they were selling or at what price. Orders were executed blindly. A man might sell his shares at 9 a.m. and not know the price until 2 p.m., by which point the stock had fallen another 20%. By the end of the day, the Dow had fallen another 12%. In 2 days, the market lost a quarter of its value. Billions of dollars evaporated. Fortunes built over decades disappeared in hours. On the trading floor, grown men sobbed openly. Ticker tape piled knee-deep. Runners sprinted between desks, trying to keep up with orders. The noise was deafening, shouting, screaming, the constant clatter of the ticker machines. And through it all, a suffocating realization. No one was coming to save them. Not the bankers, not the government, not anyone. The free market, which was supposed to correct itself, had become a guillotine. But the real horror wasn't the crash itself. It was what came after. Many believed the market would recover quickly. It always had before. After the panic of 1907, it bounced back. After World War I, it soared. This time was different. By mid-November, the Dow had fallen to 198, half its peak value. Investors who bought the dip thinking they were smart lost everything. By 1930, it dropped to 150, then 100, then 60. By July 1932, the Dow bottomed at 41. That's an 89% decline from the top. If you had invested $10,000 at the peak in 1929, by 1932 you had $1,100 left. And that's if you held on. Most people were forced to sell much earlier, wiped out by margin calls or desperate for cash to survive. The crash destroyed more than wealth. It destroyed trust. Banks failed by the thousands. Between 1930 and 1933, nearly 10,000 banks collapsed. When a bank failed, depositors lost everything. There was no FDIC insurance, no government guarantee. Your savings simply vanished. People who survived the crash lost everything in bank runs. Lines stretched for blocks as desperate depositors tried to withdraw their money before the doors closed forever. Some banks failed while people were still standing in line. One minute your money was there, the next it was gone. 9 million savings accounts were wiped out, life savings that families had built over generations, gone overnight. Unemployment soared. By 1933, a quarter of the American workforce had no job, no income, no prospects, 13 million people out of work. Shanty towns, called Hoovervilles after President Herbert Hoover, sprang up in every major city. In New York's Central Park, families lived in cardboard boxes. In California's farmland, migrant workers slept in ditches. Families who once owned homes lived in tents made from old tarp and scraps. Bread lines stretched for blocks. Men who once wore suits and ties to work now stood in soup lines, ashamed, hungry, broken. The Roaring Twenties had turned into the Great Depression, and no one knew when or if it would end. What caused the crash? Overconfidence, speculation, leverage, lack of regulation. The belief that this time was different. The 1920s had seen extraordinary technological progress: cars, radios, electricity, motion pictures, airplanes. People confused innovation with invincibility. They believed prosperity was permanent. They were wrong. Markets are not rational. They are emotional. And when fear replaces greed, the collapse is swift and merciless. Every bull market ends the same way, with the majority convinced it never will. Could it happen again? Look around. Margin debt today is higher than it was in 1929 as a percentage of GDP. Retail investors pile into meme stocks and cryptocurrency with borrowed money, convinced that the old rules don't apply. Financial influencers on social media promise easy wealth. Day traders quit their jobs to trade full-time, believing the market only goes up. The phrase, "this time is different," appears in every bull market, just as it did in 1929. History doesn't repeat, but it rhymes. And the rhyme is getting louder. Black Tuesday wasn't just about stock prices, it was about hubris. About believing that the rules of gravity don't apply when everyone is flying high. They do apply. They always do. And when the fall comes, it comes fast. The market doesn't call ahead. It doesn't send warnings. It just opens one morning and everything changes. 16 million shares, $30 billion. Gone. And with it, the illusion that prosperity was permanent. The crash of 1929 taught a generation that markets can destroy as quickly as they create. The question is, has the current generation learned that lesson? Or are we simply waiting for our own Black Tuesday?